Welcome back to Indianomics. The Reserve Bank, in a sudden move on Saturday afternoon, took away all the deposits that banks had collected from September 16 to November 11th as a CRR impounding. Basically, this means that banks have raised that money at between 4 and 6%, but they have to hand it over to the Reserve Bank at 0%. It's a temporary measure, though, and the Reserve Bank will review it on December 9th. However, for the moment, there is at least for between 2 and 4 weeks, a loss of interest. How much and who will be hurt most? Parag Zariwala, the banking analyst at Religare Capital Markets, joins us. In a bit, we are going to be joined by a lot of big bankers, Arun Tiwari, the chairman and manager of Union Bank, as well as Anant Narayan of Standard Chartered Bank. Parag, quickly, if you can tell me, how much are you calculating mathematically will be the loss for banks?
See, if you look at 3.3 lakh crore is approximately around 3% of the overall banking system NDTL. So I think on 3% you are definitely going to lose reverse repo amount of 5.75% which you are going to get. So net that means is around 18 basis to 20 basis point loss. So margin impact is not that great, Lata. If you look at arithmetically,
P&L impact
margin is not more than 2 to 3. P&L impact could be around. The point is that the analysts on the street were expecting that this is going to continue for till December end or probably also into January, and everybody was expecting 3 to 5% of profits because of this entire demonetization exercise. So I think that 3 to 5% of the profit will get wiped away, and I think the simple arithmetic is on 3 lakh crore you are not going to get anything, and the balance 6-7 lakh crore whatever you are going to get is going to be nullified against this loss of interest. So the 3 to 5% of the profit is wiped away now.
Would you say that public and private banks will take the same kind of hit because this measure applies largely to the period before demonetization? Only 2 days of probably cash collection after demonetization is factored in, and private sector banks were fairly aggressive in the way they were collecting deposits before that, all the way from September 16. Actually, I looked at the September 16 to September 30th deposit collection. It is an unusual 3.5 lakh crore. So, will the hit be equally distributed, private and public?
Yes, 100%. The hit is actually equally distributed, and not to somebody like SBI, which was very aggressive, and because of the shared branch presence which they have collected most of the money in demonetization. But the hit is of course fairly distributed, and more so with the banks which pay 6%, 7% interest rate on saving deposits. Their interest rate on retail deposit is also high. So those banks have collected a reasonable amount of money between September 16 and November 11. So the hit actually will be more on those guys rather than PSUs or Axis, ICICI, which is relatively larger bank.
Okay.
So yeah, hit is equally distributed, and more so on the small banks which were very aggressive on deposit taking.
Okay, Srini Varadarajan of Axis Bank is with us. Srini, any reaction?
No, I think one other factor which was an event which one needs to sort of factor in as far as this period is concerned is FCNR redemptions. So the FCNR redemptions would lead to a contraction of deposits during this period. So whoever has a lot more FCNR would be a beneficiary, because his deposit growth is going to come off.
Okay, no, that's a fair point, and I think a lot of it went out in mid-October.
Mid to end October.
Yeah, so I noticed about 5 billion is what Reserve Bank sold. Besides that, of course, there would be other deposits that left. Actually, we have another banker joining us. Arun Tiwari, chairman and manager of Union Bank, joins us on the phone line. Morning, Mr. Tiwari. Thank you very much for joining us. Well, what's the impact on Union Bank itself?
No, in fact, you all panelists were talking, I could hear for a short while. Impact would be there for sure on P&L to some extent, but if for a while, if we assume that this was not to be done, what would have happened? In absence of this move, perhaps the overnight markets might have gone for dislocation. And Reserve Bank has a limit for total crystallization. So if other option was MSS, but then permanent nature, where everybody is saying the CRR is temporary nature. So I think, given the circumstances, this was the best and quickest tool. And liquidity remains plentiful. What they have taken is just about half of it. So,
well, Mr. Tiwari, I'm sure a 90-day cash deposit bill or cash management bill or a 30-day MSS bill would have been kinder to the banks for sure. A CRR is a fairly gladiatorial step. But anyway, be that as it may, what is your attitude now to rate transmission, considering that the Reserve Bank may suddenly take away what you thought is your permanent money?
The big regulator, they have all the rights to take it away, but perhaps in as much as the transmission is concerned, it would be happening now going forward at a faster pace.
Faster pace? You're not even sure the money will be with you? You will be able to transmit?
Sorry?
You are not even sure all the money will be with you? It could be impounded further.
You're talking from a CRR point of view.
Exactly. Since the money is, you're not able to use that money.
Yeah, I'm
will you still be able to transmit?
No. I mistook that as a MCRR.
Okay. Yeah.
Just one thing. It's not just the 100%. No, there is no clarity on Saturday's notification of Reserve Bank that I will still be required to keep the 21.75% SLR on this. So it's not just the 100% on this incremental. I'll have to add to this 21.75% of SLR. And what about the existing 4% rate of CRR?
Oh, you mean both you have to keep?
Yeah, we have to both. I think this incremental CRR is over and above the existing SLR.
I don't know SLR whether you all are very worried because anyway you will want to put it in bonds, but
see 4% CRR also stays.
So 104%.
Yeah.
No, it's effectively 124.75%.
Okay, no, to be fair, you are getting an interest from the government securities, you have to admit, although the impounding of the amount of money is fair. But no, that is exactly the point, Mr. Tiwari. If all the bankers are not sure how much money they are going to make on the incremental deposits, will there not be a hesitation to cut rates?
Yeah, for sure. Going forward, I think most of the banks, Monday onwards, they'll be slashing the rate of interest.
They'll be slashing their rate of interest on deposits. Will you also slash MCLR?
I have no option.
Okay. How much do you think interest rates can fall from the lending side over the next 2 months, say?
I am sure it should fall somewhere around 25 basis point minimum.
All right.
Most minimum.
Okay. And you think your P&L for October, December quarter is going to be impacted by this whole thing? And how much?
In fact, if I look at just October month, we have made enough money also in our treasury gain. So maybe to some extent it will be offsetted. And December, maybe I don't have a ballpark number, but could be a slight dip in my P&L. Okay. But looking overall, I think the whole exercise, starting 8 midnight, it will be beneficial to the macroeconomic apparatus.
Okay. All right, Mr. Tiwari, we'll leave it at that. Thank you very much indeed for joining us. Anant Narayan has also joined us. Anant, thank you for your patience. Amandeep was just telling us that there could be about a 10 basis point hit in the bond yields, that is, they could rise. But Srini believes that at lower levels of bond prices, there will be buying. You probably missed that chat. What's your own sense of the moves in the bond market Monday and from Monday?
Morning, Lata. Yes, this year seems to have kept us busy during weekends as well for far more number of times than we all would have liked. I think both Amandeep and Srini have a point. To start with, though, I think some amount of clarity on what the operative principle is would be useful. So look, yesterday's announcement did come as a bit of a surprise. While we were all expecting that given this humongous amount of liquidity sloshing in the system, some steps were inevitable, right? You had CRR possibility, you had MSS possibility, and you had reverse OMOs as a possibility. Besides, of course, absorbing the money through reverse repos. Now, the extent of the CRR hike, which is effectively like a 3% hike for this fortnight, is clearly a large number. Out of 5 lakh crores of reverse repo money, 3.25 lakhs is effectively gone off through a CRR hike. Now, notice that RBI nowhere has specified that they are deviating away from their neutral liquidity policy. I think one fear which I have, which could do with some clarity from the regulator, is that this is it. They intend to keep money as a surplus, net surplus, i.e. that the reverse repo window will be operative and will be open for some significant amounts of money going forward. Imagine that beyond this CRR hike, if we actually see action coming through on MSS as well as on reverse OMOs as a means to bring the system closer to liquidity, that will have a dramatic impact both on transmission as well as on bond yields.
Okay.
So that, I think, is an open question, given the sheer size of the CRR. One would have thought, one third each on CRR, MSS, and maybe a bit of reverse OMOs, or thereabouts. So clarity that they don't intend to do anything else, that they intend to use the reverse repo window for the time being would be very, very useful, both for bond markets as well as for the transmission.
Yeah.
Second point on transmission, see, clearly this will have an impact on transmission. While, banks will be in a fix as to, given that we don't know what's going to come next from the RBI, will there be further increase in CRR given that deposits will increase further? Should we be rather reducing deposit rates? At the same time, if you do that, you're also tied to MCLR, which means your lending rates come down, whereas your cost of transmission is increasing, something that cannot be factored into your lending rates right now. So that confusion will remain as well.
Yeah.
Having said that, to Srini's point, look, the underlying fundamentals haven't changed as yet. We still have growth for this quarter, which is going to be terribly impacted. We still have inflation, therefore, coming down. We still have the need for rates to come down, which I think everybody agrees with.
Yes.
And therefore, the 6th December policy will probably bring about a rate cut, maybe even larger than we expect. So that impulse hasn't really gone away, notwithstanding what's happening as of yesterday and, of course, what's happening in the rest of the world. So all makes for a nice, confusing hodgepodge on a Sunday. Having said that, there are questions I think we could do with some clarity with. Ideally, the operative principle under which we're going through for liquidity over the next few weeks, if RBI can pre-specify rather than come out with things which are somewhat retrospective. Notice that, what has come out yesterday is retrospective.
Absolutely.
26th and 27th, we are short of CRR. In fact, we will have to, while the money will come back in reverse repo over Monday through Wednesday, we will not be having enough funds as of tomorrow. We will actually have to probably hit the last repo window to make up for CRR.
Okay. Well, Anant, thank you for pointing out a lot of the other side. That, even now, if the Reserve Bank were to sell MSS bonds or do a reverse OMO, another point of view also opens up, and that is still very much on the table as well, the immediate impact on the shorter end of the curve. One more question before we take the break. Vikas Khemani, you have heard the bankers and the hesitation to cut rates and the impact on bonds. Any last thoughts on what markets will do on Monday?
So I think, bank stocks have been relatively outperforming other sectors in the recent past November. I think you might end up seeing some of that being given away. And I don't think there'll be massive sell-off and they'll kind of panic kind of situation. But yes, they will give away some amount of outperformance which we saw in the recent past. Okay. And I think wait for more clarity. Yeah,
you're right that on Bank Nifty on Friday rose by 1.4%, 1.37%, whereas Nifty rose by 1.87%. So there were, stocks other than banks which were clearly pushing up, and metals and even tech have been doing extremely well. But how much will we give away at an index level, you think?
Difficult to say because, but I would, very difficult to say that what kind of, reaction we'll see at overall index level. But the bank stocks have outperformed since 8th November. Yes. I mean, yesterday was a point aberration. But so I would say some of that might go away, and we might see maybe 0.5% to kind of correction at index level. I mean, very difficult to say how, but given banking weighted.
I take your point. Bank of Baroda, for instance, month to date has a rise of about 7.87%, and we know that the Nifty contract ended with 7.8% in terms of losses. So the measure of the public sector bank outperformance is actually 15%. They have not lost like the Sensex and the Nifty, and they have in fact shown an outperformance. We have to take a break. We are back in a jiffy with concluding comments from our experts.